Today we're going to talk about how the Federal Reserve manages the money supply. A little bit of history is necessary for this one so that we can understand where we've come from and where we're going to right now in such a severe inflationary cycle that we're involved in currently. The challenge here is that the M1 money supply was the traditional way that we used to look at the money supply and see how much money there was in circulation. Part of the challenge with this is that big hockey stick you see in the middle, just between July of 2020 and January of 2020. What was the cause of that? So what we need to do is to first determine what the cause of this big increase that we see in the M1 money supply. And so when we look at the M2 money supply, we see a much more gradual rise there. And I suspect that something went on that is not normal or not usual, because notice the bottom of this graph. They're not the same scale. The bottom of this graph is a little below 15 trillion, where the bottom of this graph is a bit below 6. So what was this dramatic increase in M1? Well, in doing a little bit of research, I found that there's a thing called Regulation D, and Regulation D basically said that banks would charge a fee for people taking money out of savings any more than 6 times. So the savings was considered what they call non-liquid or less liquid form of money. And because it was less liquid than the totally liquid funds that you have attached to your checking accounts, it was considered part of the M2 number. So M2 number would have those funds that are in savings where the M1 number wouldn't. Well, so the Regulation D basically said that banks were not required to keep that money in-house in order to give out at a moment's notice like they would with a checking account. You have to always be liquid with a checking account. Somebody could drain their checking account in a moment, even if they had thousands of dollars in it. The challenge is that in April of 2020, looks like about this time here, they changed the regulation where they were not going to require banks to charge that 6 transfer limit and charge a fee beyond that 6 transfer limit. And basically what happened then is all those savings accounts became liquid just like checking accounts. And so what we have is, while the M2 figure down here contained those bits of savings, the M1 figure did not. Now the M2 figure also has things like money markets and things that are, fairly liquid. You have to put in some effort and you pay a penalty to get them out, but they're not impossible to get to, unlike stocks and bonds and certificates and items like that, where it takes quite a bit of money, quite a bit of time and effort to liquidate it. Homes would be one case where you have wealth in your home, but it takes a while to liquidate that and get money out of that. So as we move on, what we want to do is examine that. So between February 2020 and May of 2020, the amounts I've posted here showing, 4 trillion there up to 16 trillion there. And here I've marked these the same times at 15 trillion up to the 17, almost 18 trillion there. And if we do the math, we find that the M1 figure went up 12.227 trillion, where the M2 figure went up only 2.36 trillion. So realistically, what we can do is attribute about 10 trillion there, take the subtraction of those two, to just the change in the Regulation D requirement. So what we're going to do then is we're going to rely on the M2 figure from now on. We're not going to rely on M1 anymore, because M1 now basically is identical to M2, at least mostly. I mean, you see the numbers total out here. This is the current to date total, and they're a little bit apart. They're a little bit more than 1 trillion apart. So we're going to tell our story, we're going to go forward just with the M2 figure here. So as we go through here, what we want to do is figure out, what's happened with the money supply between, let's say, June of 2019 and now, because we've seen a dramatic increase. Even this is an incredibly dramatic increase in the money supply. And with this being that much of an increase in the money supply, here, just in this little portion, was a 6.56 increase. So if we go then back to this figure, what is the increase between here and there? And so during the 31 months that we're talking about, there was a $6.87 trillion increase in the money supply. And that's a 46.45% increase in just those 31 months. So what would lead the Federal Reserve to increase the money supply by half of what it was before, to go from 14 clear up to 21? So let's examine that a little bit. Where did we see in the economy that this money seemed to be impacting the economy? And we can see that in the stock market, the Dow Jones Industrial Average during that same period of time increased 21.96%. That's quite an increase over that 31-month period of time. A lot of money was made during those 31 months. Basically, it's 10% per year, just with an average. Now, certain stocks, of course, did a whole lot better than that. The housing market. Oh, man, if anybody's been worried about buying a house during this time, I know I've heard stories from my friends in the Seattle area that basically said they were putting in as many as 20 or 30 different offers before they got one accepted. And during this period of time, they were actually being aggressive and offering, 5 to 10% more than the original asking price, which amounted to, sometimes 30, 40, 60,000 more than the original asking price. The prices were being bid up. In other words, the supply of money chasing the amount of available housing was so high that it continued to drive prices forward in that housing market for this 31-month period of time to 43%. Now, increase of money supply was 46%, 43%. We've got a little bit of a correlation that we can look at there. The next thing is inflation during that period of time was impacted. We saw that the Federal Reserve, in spite of the fact that inflation starting in about February of 2020 was residing right around 4%, in spite of the fact that it was outside their normal range of about 2% inflation, they continued to juice the money supply and keep putting more and more money out there. So during that 31-month period of time, we see an 11.2% increase in just inflation. Now, part of the challenge, though, is that inflation is a lagging indicator. In other words, the Fed can increase money supply quite a bit and not impact inflation all that much because they've got other levers they can use. Well, one of those levers is the interest rates that they charge to member banks, which impacts the mortgage rates and so forth. Well, part of the problem is during this whole time, they had that interest rate at about 0.25, really, really low historically. But now everything usually comes to roost because this whole thing has to unwind. It has to come through the economy and it has to eventually balance itself. So now what we have is inflation between January of 2022, which is where I stopped calculating these numbers. January 2022 till June, the first 6 months of this year, inflation has been 3.96, nearly 4% increase in prices just since January. Now, we're not talking year over year because remember the June figure for year over year was 8.6%. So since June of last year, it's been 8.6%. Since January, it's been half of that, a little less than half of that, actually. So what we have is a situation where this money is driving inflation. In other words, there's too few goods out there. When we talk about the supply chain problems that we're having, the stores are having a hard time keeping things on the shelves. The way you keep things on the shelves a little bit longer is to charge more so that some people choose not to buy it. So you reduce the amount of demand so that it kind of meets the supply. And in doing that, inflation is caused. And so what we have is a situation where it looks like the Federal Reserve, in order to keep the economy moving through the COVID virus and the challenges with COVID, was pushing way too much money into the economy. And we're now starting to pay the price with high inflation. We've been paying the price with high inflation in the housing market, and the stock market has been the beneficiary of a lot of investment money that has pushed the stock market forward. But now, as it starts to unwind, we see the stock market tumbling. We see the housing market leveling off. We see interest rates in the housing market at 5.5% now, where it was historically at about 3 or 4% for the last several years. Now we're seeing it jump quite dramatically. And it's knocking a lot of people out of the housing market with the prices being so high. So we're going to watch inflation over the next while. We're going to watch the money supply. If we look at this next graph, we see that they're starting to decrease the amount of money. Notice here that in March it was 21.81. This is where the decrease started, and now it's gone down by 0.08 trillion. So we can see that the Federal Reserve is now starting to pull back some of that money and decrease the money supply a bit, as well as increasing interest rates. And what that will do is it will decrease the amount of demand for products and for labor. And what it's going to do is put people out of work. The unemployment rate is going to increase, but at the same time, inflation is going to decrease as well. It'll be a painful period, but that's the way the Fed works. We go through these cycles constantly where we go into a recessionary period, and we're headed for one now. I hope you've enjoyed this. I hope if you like what you see, please hit that subscribe button and help me grow this channel, and we'll look forward to seeing you again later. Thanks.